Good Monday morning, Market Chameleons, and those joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker dealer. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
So had a pretty rough weekend this weekend at home. I don't know if you heard anything.
Floods? Oh, I heard. I thought you were down the shore. So
No, I was actually in Maryland with my daughter, but my wife was home, and they had 5 inches of rain in less than an hour. And there was some flash flooding, and 7 people lost their lives. So it's,
yeah, it was terrible.
very, very sad. I mean, it's a road that heads down a valley, and there's a creek at like the end where the hill picks up on the other side of the road.
Right.
And the water got as high as, I don't know, 5 or 10 feet. And the road going down, which runs about a half mile, was like a Russian river. So it pulled cars that were caught in it all the way down to where this creek meets, and the creek took them right down towards the Delaware. I mean, it was terrifying. And that's a mile away.
Yeah.
So
has that ever happened before?
You know what? That creek can fill up in a rain and start to push over into the road a little bit, an inch or so. But you know, it's like if you look online and see the videos, I mean, it was literally a Russian river down this hill.
Wow.
And pretty terrifying. And tragic.
What is it? How is it now?
Well, the road's all closed. I mean, they're still searching tragically for a few bodies. The road's closed and I think damaged, and the road I live on is closed. I'm right around the corner. So it's really a shock to the entire community. So anyways, heed those warnings. When they say flash floods, be aware where you're driving your car. Never go through water. This wasn't people going through water. These were people just caught on the road at a wrong time. And were like trapped, like within minutes, it was 5-6 inches of water on the road. And that's enough to pick up your tires and just push you down the hill. So it pushed them literally in, hundreds and hundreds of yards into the water. And then, it's terrifying.
Tragic. It's tragic.
Yeah, it really is. So sorry to bring that up, but I thought it was a worthwhile public service announcement. Never go through water, and watch that flash flood on the phone. It's real for sure.
Yeah.
What's going on this morning? Anything good?
Yeah, let me share my screen. As I'm sharing my screen, if anybody out there, if you're joining us for the first time, Will and I, we do this show in the morning to help answer questions you may have about the Market Chameleon tools, data, or analytics. If you want to come on the show and ask your question live, we do provide a link to Zoom on the live chat on YouTube. If you click on it and it takes you over to Zoom, click on raise your hand. You could ask your question live. If you prefer to type your question, you could type it into the live chat on YouTube. Will's watching it. He'll read those questions back to me. While we're waiting for questions to come in or more people to join us, we'll start out taking a look at the pre-market report to see if we can get some insights on what's trading in pre-market hours. And then we'll go to the questions. And if we don't have questions, I'll just try to navigate to a tool, see if we could get some insights from a different tool.
Perfect. Okay.
So pre-market trading, these are stocks trading in the pre-market hours. And I'm going to come down here and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Down here, I see 38 stocks made our percentage gainers list, 45 on our decliners. So from this perspective, right now, we're looking like we're setting up for a bearish bias at the open, slightly bearish. But let's check another stat here. I'm going to come up here. We have a calendar view. Right now, we're July 17th. So this is what's going on from a high level in the pre-market hours. It's looking at all the stocks trading in the pre-market hours. There are 378 stocks so far trading higher than the previous day's close, which would be Friday's close, 386 lower. So this is, kind of even here, slightly tilted towards the bearish side. As far as volume goes, 85.7 million shares trading higher versus 52.6 million shares trading lower. So that's more bullish than bearish. And then as far as dollar value of the stocks, $2.2 billion worth of stock trading higher versus 1.4 billion lower. So that also looks more bullish than bearish. So kind of mixed signals here. So I would say, pretty neutral, I would say at the open. But we could come down here and filter this list down a little bit further, because if you look at it, we see that there are stocks in there that are small cap stocks that made our list, ETFs. It could be a leveraged product, preferred stock, pretty much anything listed on a major US exchange. If it's trading in pre-market hours and meets our thresholds, it could make this list. And to narrow it down, we could use the filters above. So I'm going to use this one in ETF for the different filters. When you click on it, get a drop-down menu to choose from. It's a list of ETFs. Some of them are broad-based ETFs, some are sector-based ETFs. The first one, SPY, that's the S&P 500 ETF. If you click on it, the table below will get filtered by stocks that are holdings in the SPY ETF. And here we see 2 stocks made our percentage gainers list, 6 on our decliners. So that also mixed bag, but slightly more bearish than bullish at the open. But I would say right now it's kind of around neutral. So we gave it a couple minutes. Well, if there's any questions, I'll take them now. If not, we'll move on.
Yeah, you can move on.
Okay. Let me use SPY as an example here. Let me go to options chain in SPY. So there's a question, I guess it was regarding the theoretical values over here. So this is the options chain. And here we have bids and offers for calls, bids and offers for puts. Kind of in the middle as a reference, we could generate theoretical values for these options to see, are they relatively priced high or low? And we could control these theoretical values by changing assumptions. So right now, it's set to the best fit volatility curve. So before we change this, well, what is the best fit volatility curve? It looks at the observations in this chain for this expiration, and it goes through the implied vols, and we see that there are different implied volatilities for different strikes, right? So this is around the at the money. You can see this here is the implied volatility of the bid, implied volatility of the offer for this option, and they change, right? They change by strike, going down, going up. So the best fit will look at the smile. It'll take the observations and say, well, if we ran a best fit line that's a little bit more smooth, not jagged, because some of these could be more jaggedy. If we ran a regression curve around the implied volatilities, what would the theos be? So this is like a smoothed out curve. So that's the initial default. It's looking at the markets and calculating the implied vols, then smoothing them out to look at what would, in theory, these options be. And really, the idea there is just to point out anything that might be, way out of line relative to the other options, right? That's the idea. Like, is there something that looks out of line on a particular strike related to the options surrounding it? But we could change that model too, and we could say, well, I just want to fit, let's say, my own volatility. So if I inputted volatility, I could run theoretical values through each one. So if I input a straight vol, let's just say I think that volatility will be, what are we at right now? Let's say 10, right? And I want to run 10 through each option. Okay, I'm not running a curve, nothing. I'm going to just run the same exact implied volatility through each option. And I want to see what the Theo is relative to the market prices. Okay, so I could enter in 10 here, put in custom volatility, enter in 10, press OK. And this will recalculate the volatility for me. And now we have the market prices. And now we see, in theory, if implied vols were 10, then this would be the call. If the implied volatility was 10, this would be the put. And we can compare that to the market prices. Okay. As you can see here, the implied vols are going up. So then the market prices are above. And here the implied volatilities are going lower, below 10. So you could see that the market prices are below the Theo. If we wanted to change that assumption, instead of 10, let's just say, well, what if the implied volatility between now and July 24th, the end of this week, matches the last 20 days, right? So what if it's the last 20 days? Well, let me refresh this. Where was that, on July 24th?
I think, yeah.
July 24th. So then what I'll do is create this Theo and say, well, what if the volatility going forward is where the last 20 days were? We don't know for sure, but what if it matches the last 20 days? Where should these option prices be, right? Where would they theoretically be priced? So we enter it in, and we could see that right now, we could see that these Theos are priced higher than the markets. So what are the markets saying? That in the next 6 business days, volatility will probably trade lower than in the last 20 days historically, right? But of course, there's a smile here, so that changes by option. And when we create theoretical values or pricing models, there's a few things to understand about models, right? When we price things out, some are going to be here. Let me bring up my paint. So it's, and pricing models are extremely important if you're trading, right? Because those are your benchmarks, those are your models that you want to trade around and tweak and improve. So sometimes we could create a model that's based on observed values. Okay, so we could price a certain asset based on the real-time market prices, and then we take those, we put them through a model, price the asset. For example, an ETF, right? We could recreate ETF NAV by, the holdings. What are the holdings in their stock holdings and their stock prices, right? So we could say, what is this ETF worth? Well, we know what the price of the ETF is, but in theory, what is it really worth if I took the holdings, the weightings, multiplied them by the current prices? What is this ETF worth? And then I could look it up in the market and see if there's a discrepancy, or did the market prices deviate from its net asset value, right? So that's a model that is using observed prices that we could go out there and fetch, and we know. Then there are models. Sorry, guys. And this is going to be most models. They need assumptions and forecasts inputs. And this is the hardest part, because that's where a lot of people are going to differ, right? When you start going into assumptions and forecasts, there's no exact number because we can't observe it. We're trying to input a guess, a maybe calculated or educated guess or assumption or forecast, but we don't know for sure. Like an ETF, we will know here's the price of Apple, here's the price of Microsoft, here's the price of Google, this is the weighting. If I multiply the prices by the weighting, I could, add them up and I come up with the NAV. So there's not really a difference of opinion there. There's nothing subjective about it. But most models are not like that. And that's where, it comes in, where you have to really get good at it. How much trust do you have in it? You're evaluating the model constantly. So take an option pricing model, right? When we're just looking at, well, what does an option pricing need? If I want to create a theoretical value that's, let's say, 20 days away, 50 days away, 100 days away, whatever it is, well, what do I need? Well, first I need, what interest rate do I input? Because interest rates could change. They could go up, go down. If you're a year away right now, we could observe what the market actually thinks interest rates will be, right? Because the people are betting on treasuries and so forth, but you still have to make an assumption because we don't know for sure. We don't know exactly for sure what the interest rates will be. We're going to have a interest rate decision right now in July. We don't know exactly what they're going to do. We have an assumption. Usually, the markets are good at the very short term, the next meeting, but not going out. What about dividend? Right? Well, if a stock pays a dividend, what is the dividend? We don't know for sure until the company announces it, right? Sometimes the company, like SPY, right? Let's take a look at SPY. SPY, they will give us a schedule, right? So right here, they which gives us a little bit of information that's important, because we know, well, which expirations are going to be covered for this ex-dividend. So we do have the ex-dividend date, which is nice, but they don't give us the amount, right? They don't give us the amount. We have to forecast that amount, and sometimes you don't even get this, right? But if we don't know the amount, if they're not going to tell us the exact amount until the day they go X, well, we have to project it. And especially it's hard when you have a dividend that looks, it's not the same amount quarter after quarter. So you got to start projecting that as well. And you don't know exactly the amount. You could just kind of make a projection or make a guess, but we don't know for sure, and we'll have to make an input that is based on either a forecast or assumption.
AD?
So, yeah.
Sarush asked a question: does adding more parameters, inputs, and data points to a model give us better pricing, or just pushes it into a curve fitting?
Yeah,
That was
so
the
that's
question.
yeah, so it's a good question where, when you create a model, you're trying to create then you start evaluating the model, right? So you start evaluating the model, and how good is it, right? So you have these performance metrics, and when let me bring this back up. Let me just finish this one, then I'll get to that question. Okay.
All right.
Yeah. So it's a good question. It's an important question, especially in data science. There's no, but let's do this last one. Then I'm going to kind of explain to people what, so they visually see what the question is as well. Maybe I'll draw a graph. So the last one is important is, volatility. What is the volatility input? If you want a price, you got to put in, what do you think the volatility in the next 20 days or the next 30 days, whatever you're doing? Well, we don't know for sure. Nobody gives us that answer. It's not like, a stock price that we could observe. That itself is an assumption. It's an input. It's a forecast. It's a prediction, but we don't know. And that's one of the main things with models that people have to understand is that, you're dealing with trying to tweak and your forecast, and they're never going to be, you're always going to have an error, right? It's just, how do you minimize that error? How do you minimize your error? How do you get better at it? So this way you could detect when the markets have, moved to some extreme level and away from even from what you would anticipate, right? So let's move to this. So what is overfitting? Let's do this. So let's say this is your model's prediction, right? Based on whatever, if the stock price is here, this is here, this is where you think your prediction is. And then you're going to get these actual values. Oops, sorry. And then you compare them to the actual values. Whoops. Well, your prediction, when these things hit, your prediction was this line, the actual value here. This one, then over here, over here, over here, So how close were your predictions to the actual values? How far away were you? Because you're not going to get exact, right? If you got exact, then you got, that will be the best model I've ever seen. So you're trying to see, how do I minimize, right, these errors? So these would be called, errors or loss functions, whatever. Data scientists have different ways of describing it, but basically these are your errors, right? And you want to minimize, right, the distance between your predictions and the actuals. That's what model building, right? The better your model, hopefully the more you're minimizing, right? Because if you have them all over the place, like down here, up here, then your model is just not that good. So you're trying to minimize those errors. And what is overfitting? So overfitting could be if you take the historical data, right? So you're looking at the historical data and you're tweaking your model, right? You're tweaking your model to exactly fit the data. So you're like, well, I'm going to do, instead of a regression line, I'm going to do a polynomial. I'm going to do it to the, to the 10th degree. I want to fit every single point, right? Every single point that whatever I have to do, with a million coefficients to the 20th degree, whatever it is I have to do, I'm going to fit every single point. So my model was perfect, exactly perfect on the historical data, right? So that also cannot be, that could be overfitting, right? Because what you're doing is just trying to make your model fit the historical data perfectly. And that doesn't mean that going forward, your model is going to perform perfectly. So what happens is that as you're building your model, you're not trying to get it, you're not going to get it perfect, right? You're not going to get it perfect. You're trying to make a practical model that is good, that you're going to continuously evaluate, maybe tweak, but it's practical, not perfect. And the most standard way, the most standard way of testing that is you split your model into, let's say, 80-20. You have a learning, right? You have learning and then testing or training, right? Let's say, so your model takes, let's say, 80% of the data, and that's where you develop the model, right? So 80% of the data you're going to take and you're going to say, okay, let's take the historical data. I'm going to split it. The last 20%, the most recent 20%, I'm not going to even use in my model building. Okay, so I'm not going to train my model. I'm not going to do anything, teach my model nothing on 20% of the data. So that model never sees this data, right? So this model never sees this 20%, 80% you're training, which is kind of like a standard. Then once you build that model, you say, okay, I think that my model looks pretty good. Now I'm going to use it on data that it's never seen, right? It's never seen this data. And then what did the model predict versus the actual? And then that's where you start testing it and saying, okay, well, in a regression, you'll get an R square. You could get your standard error, your mean standard error, absolute standard, so you have all these metrics then, that you could start using to see, okay, this is the model prediction, and these were the actual data points that the model did not see, right? So these were, model never seen these points. They never seen these, so it couldn't be an overfitting because it never even took these 20% into account. This is just going forward, right? And then you kind of look at it and say, well, how did these error? Okay, how did these error? And you look at it from different perspectives, right? You could look at it from the distance. Well, you could look at it for outliers. And then this data itself can point something out, or maybe just tells you don't have a good model. But usually, you're looking at it from a perspective and say, well, okay, this is interesting. What did I miss here? Then you could have certain outliers that you didn't consider. You'd have to go back potentially, maybe seasonality. You could look at it from, well, if I lined up, instead of looking at it from this point of view, prediction versus actual, let me line it up in time. How did these errors look over time? And let's say, over a certain period, maybe, there's a seasonality in there that you overestimated or underestimated. So then you could go back and do that. So there are techniques that you want to use to make sure, yes, you don't want to overfit your model, because then what you're doing is just trying to fit it exactly to the historical data, which means that it's not necessarily going to move exactly the same way going forward. So those are like different techniques that one of the techniques that you could use, but usually you want to split the data. And then even after that, once you're done this, there's an entire evaluation, right? Going forward, because you should be always monitoring your model and evaluating it you could do it week to week, quarter to quarter, day to day, but you're still constantly evaluating your model as after employment. So I'm going to stop there. We're right up at 9:30. Will.
Awesome job, Dima. Thanks
Okay.
as always, my friend.
Yep. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.